This is Herbert F with MainStreet Financial Group, and it's that special time for us to pull away a little bit to discuss the movement of our markets from last week's action, or actually inaction, to our best guess for what the next week has in store for us as we go back to the world trade for the fourth quarter of 2019. Wow, how time flies. It's Sunday, September 29, 2019, and a special day for me is it's my sister Pat Allen's birthday. So wise on the markets, way beyond me, and most brilliant and creative person I've ever known. So on to more common memories. I spent the past week in Central Europe, and much of it working with pound sterling, Swiss francs, and the giant among them, of course, the euro. There's no doubt anywhere in Europe that the US dollar remains king and the favored currency of the Western world. On Friday, the euro fell to its lowest level since May of 17. Pound sterling fell to a new 3-week low against the dollar, and against a basket of worthy foes and rivals, the U.S. dollar moved up, the highest level we've seen in 3 weeks. All of this action endorses the strength of the U.S. currency in a week that really was posed with a pretty nasty image of the U.S. and Washington all around Europe. The global market does not appear to have lost a sense of respect for the leadership of the U.S., at least in terms of leading global market maker. A practical point to all this talk on currency, though, it's a fine time to make a late season visit to Europe for U.S. tourists. Think about it. More value to your dollar and fewer tourists to contend with. Don't be afraid at all, though you do need to have caution among the bicyclists in Amsterdam. I don't think there's a greater threat for tourism in Europe. So, back to thoughts on Europe again, more practical, I guess. I found the presence of commercial building, growingness of huge cranes, and a certain bravado among European economists and journalists to be rather unsettling. Though all the signs of economic weakness are there for the geeks among us, in terms of data, you'd find it difficult to find consumers or business owners speaking of bad times around the corner. Hotels, restaurants, shopping areas are full and appear vital. All this matters to us as investors because, in the simplest of terms, without Europe holding its own strength, a global recession is inevitable and likely to draw us into it. So let's go to a quick summary of last week in September, and it can be summarized as pretty disappointing. Equities fell for the second week in a row. The on again, off again U.S.-Chinese trade tiff brought the market down and then up on Wednesday and then down again on Friday, with the White House suggesting significant restrictions on U.S. investments in China against the embarrassing and clownish behavior of our national politicians. We had economic data that was modest at best, beastly for sure. The Consumer Confidence Index actually fell more than expected, and we saw clear signs that consumer spending actually rose 0.1% in August. That's a bad sign. It's the slowest growth since February. Business investment fell in August for the second straight month in a row, but on a positive note, we had solid and robust new home sales in August. So essentially, the third quarter was volatile and pretty much a bust for the world's markets. And so looking forward to the coming week, we can find the fourth quarter of 2019 an important point when it's all supposed to come together for a great close to the market year. Well, here are some of my thoughts on that. While October is often seen as the worst trading month of the year, it's a myth. But that's because its history of hosting some of the worst market moments, like the Wall Street panic of 1907, Black Tuesday of 1927, Black Thursday, 1929, Black Monday, 1987, and the very worst market day, October 19, 1987, the Dow dropping 22.6% in one day. I remember that day. Probably so do many of you. While all that history is correct, and that it's true that October is very volatile, maybe the most volatile month of the year, the average return on the Dow over 114 years, it's an awful long time, is actually still 0.2%. So what do we have to look for in 2019? Well, we'll technically wrap up the third quarter on Monday and label it a dud. Most market analysts are waiting to hear from 3 of the Fed presidents who may give us a hint of possible rate cuts still this year. Major data bits, though, will be big and possible market movers. On Tuesday, we're going to hear the the Institute of Supply Management's report, and that's really geeky, but we'll also get the PMI manufacturing data, and that's really the important assessment of market strength. The major market mover, though, on an otherwise quiet week, will be the Department of Labor's September non-farm payroll report on Friday, and that will happen at 7:30 Central. Look for a number above 145,000 to drive the markets into a revived sense of growth and optimism for early October. In terms of U.S.-Chinese trade tiffs and the circus in Washington, let's do what Taylor Swift suggests. Just shake it off. Let's just shake it off. We've got life to live and markets to grow for our children and grandchildren. Let's keep it that positive way. So with the sounds of Taylor Swift in the background, let's pick it up and move forward. But know what you own and consider joining us as travel companions. You can always find us at MainStreetFinancialRockford.com, or you go retro, I love that, and actually call us on the phone at 815-965-4000. Oh, yeah. Happy birthday, Patty Ellen, the best market watcher I know. Have a great week, folks.